Most people think building passive income requires owning businesses, rental properties, or creating complicated financial systems. But ETFs have quietly become one of the simplest tools for generating long-term wealth and income. By combining diversification, low fees, and exposure to entire markets or sectors, ETFs allow investors to grow money steadily without constantly managing individual stocks. Some ETFs are even designed to generate regular income through dividends, making them feel like a passive income machine when combined with patience and compounding over time. Today we will talk about the passive income machine called ETFs, so before we get started, make sure to hit that like button, also subscribe to my channel. 10. Most people think building wealth requires constant work. For most people, money is directly connected to effort. You work hours, earn income, pay bills, and repeat the cycle again the next month. This creates the belief that wealth can only grow through continuous labor. But wealthy investors often think differently. Instead of only focusing on earning more money actively, they focus on building systems capable of generating income automatically over time. This is one reason ETFs, exchange-traded funds, became so powerful for ordinary investors. ETFs allow people to invest in entire groups of assets through a single investment, creating exposure to long-term market growth, dividends, and compounding without needing to constantly trade stocks or manage businesses directly. 9. ETFs simplify investing dramatically. One reason ETFs exploded in popularity is simplicity. Traditional investing often feels overwhelming for ordinary people. There are thousands of stocks, endless financial news, constant market predictions, and emotional pressure around choosing the right investments. Many people avoid investing entirely because they fear making mistakes. ETFs solve much of this problem by grouping many assets together into one investment. Instead of trying to predict which individual company will succeed, investors gain exposure to entire sectors, indexes, industries, or markets simultaneously. 8. Diversification reduces risk emotionally and financially. One hidden strength of ETFs is diversification. When someone buys individual stocks, their success depends heavily on the performance of a small number of companies. If one business performs poorly, the portfolio may suffer significantly. ETFs spread investments across many companies or assets simultaneously, reducing dependence on any single investment. This creates both financial and psychological advantages. Investors feel less emotional pressure because their future is not tied entirely to one company succeeding or failing. 7. ETFs quietly benefit from global economic growth. Many broad market ETFs are connected directly to long-term economic expansion. As businesses grow, industries evolve, productivity increases, and economies expand over decades, ETFs tracking major markets often benefit alongside that growth. This is one reason ETFs became powerful passive wealth tools. Investors do not need to predict every economic trend perfectly. They simply position themselves around the broader long-term expansion of business activity itself. 6. Dividends turn ETFs into income machines. Many ETFs hold dividend-paying companies, which means investors may receive regular income distributions simply from ownership. This changes how investing feels psychologically. Instead of relying only on rising prices, investors begin generating cash flow passively, while continuing to own appreciating assets. Over time, reinvesting those dividends creates powerful compounding effects. New shares purchased through reinvested dividends then generate additional dividends themselves, creating accelerating long-term growth. 5. ETFs remove much of the emotional stress from investing. One major reason many ordinary investors struggle financially is emotional decision-making. Fear causes panic selling during market crashes, while greed encourages risky buying during hype cycles. Constantly trying to outperform markets often leads to stress, overtrading, and poor long-term results. ETFs help reduce this emotional pressure because they encourage broader long-term investing rather than constant speculation. Investors stop obsessing over every company headline or market prediction. Instead, they focus on consistency, patience, and gradual wealth accumulation. This emotional simplicity is one reason ETF investing became increasingly attractive to long-term investors globally. 4. Low costs quietly increase long-term wealth. Another hidden advantage of ETFs is efficiency. Many actively managed investment strategies charge high fees that slowly reduce investor returns over time. ETFs often operate with relatively low costs compared to actively managed funds. At first, these small fee differences may not seem important, but over decades they compound significantly. Lower costs allow investors to keep more of their investment growth instead of losing portions to management expenses continuously. Sophisticated investors understand something many beginners overlook. Minimizing unnecessary costs can dramatically improve long-term wealth accumulation. 3. ETFs made investing accessible to ordinary people. Years ago, building diversified investment portfolios often required large amounts of money, financial advisors, or institutional access. ETFs changed this completely by allowing ordinary investors to access broad market exposure with relatively small investments. This democratization of investing became one of the biggest financial shifts of the modern era. People no longer needed enormous capital to participate in market growth. 2. ETFs reward patience more than prediction. One of the most powerful aspects of ETF investing is that success depends less on predicting the future perfectly and more on remaining consistent over time. Many people believe investing requires constant market timing, advanced financial knowledge, or predicting economic events accurately. ETFs challenge this belief because long-term results often come from discipline rather than prediction. 1. The real reason ETFs became passive income machines. The deeper truth about ETFs is that they allow ordinary people to participate directly in the long-term growth of businesses, industries, economies, and global productivity without needing to become financial experts or full-time investors themselves. Because the truth is simple, wealth is often built not through constant trading or chasing hype, but through ownership of productive systems compounding steadily over time. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.